Hi, this is Oli Hille on the 6th of May 2014. That's in New Zealand. In the US it is the 5th of May 2014, just being the close of the Dow on that date. So welcome to the inaugural chart of the month from chartofthemonth.com. And before you go any further, please pause and read this disclaimer, and as it says in bold on the second to last line, if you do not agree, please discontinue watching. Okay, so the chart of the month for May 2014 is VIXY, VIXY, which I'll talk about what VIXY is in just a minute, but here is the chart of the month of the VIXY. This is a monthly chart. You can see that the most recent high in September 2011 was a price of $633.60 2.5 years ago. The current price is $26.35, and that is a 24 times multiple. Now, no one has been able to explain to me exactly why VIXY is so leveraged, much more than the VIX index, which is a futures contract, but I guess the thing is that being an exchange traded fund, it is highly leveraged, so if there is a big move in stocks, and you'll see that it trades inversely to stocks in a minute, you get a very big bang for your buck trading this exchange traded fund. Okay, here is the daily chart showing that we are at, in fact, just below the bottom of the recent range. So this is certainly not the type of stock that or trade that I usually do. I'm generally a trend trader, so this is an opposite type of stock trade. It's more of a value trade. Okay, so what exactly is VIXY? It's an exchange traded fund from the US. The fund seeks daily investment results that correspond to the performance of the S&P VIX short-term index, which means it reflects stock volatility in the S&P 500. Volatility, as you will know, is a measure for variation of price of a financial instrument over time. And the very low price in VIXY shows that the stock price volatility is very low compared to recent history. So just in terms of how to trade VIXY, it trades just like any stock in the US as an exchange traded fund. You can buy and sell it as a stock, and you can also generally do it on most trading platforms, and it is a leveraged product as well. Okay, so here is the futures contract, which is not the exchange traded fund, but just to show you, because I can get a better chart which goes right back to 2004 here, 2002 rather, and you can see that the closing price as of today, is the lowest closing price since June 2007. And the other thing to notice is that on the first chart I showed you, we only captured this piece of information from here to here. Way back around the post-GFC with the stock crash of 2008, you will see that the VIX index went almost twice as high again. So yeah, I guess if it falls that much, instead of 20 something times, it could be 50 times, possibly. Okay, another chart I want to show you, and this chart goes right back to 2005, and this is the VIX volatility index again. This is the VIX index here, and the green line is the S&P 500. The key thing I want to show you here is that when there is a small fall in the S&P 500, there is a large gain in the VIX. So we can go right back to here, very small downturn in the S&P 500, big spike in the VIX. Another one right here, another one there. That one is a little bit of a one, not much. That one's a huge one. That's another big one. There's another big one, another big one, another one, another one. This, of course, is the big fall in 2008. Obviously a massive gain in VIXY, and also you'll notice that it captured the gains quite early. Even as the S&P 500 was falling, VIXY went very hard and very fast. Here's another one. Price falls a small amount, S&P 500, big move up in the VIX. Again here, again here. So just showing you what can happen if there is a relatively small down move in the S&P 500, very large up move in the VIX. Okay, how does it trade? Essentially, it's inverse to stocks. When stocks go down, the VIX goes up, but it mainly represents volatility. It is simply that when stocks fall, they're more volatile than when they go up. And you've probably heard the term stocks go up the stairs, slowly grind their way up, and then when they fall, they go down the elevator much more quickly. Okay, why am I interested right now? Well, there's a number of reasons. One, stock volatility cannot go to zero. For that to happen, there'd have to be a complete price freeze on stock prices, which of course is not going to happen. As I said, we're at the very low end of the price spectrum, and unless we move into an unhistorical period of certainty, which is the opposite of volatility of course, VIXY is very unlikely to fall much below where we are now. In that sense, this trade is almost a call option, and you'll remember that a call option is where you have limited downside and unlimited upside, which is very good. However, a normal call option, you have to pay a premium, and it has a date when it expires. So if you've ever traded options, you'll know that as soon as you buy an option, every single day that goes past, unless price moves in your favor, the option value gets less and less and less until at the expiry your option is worthless and you've lost your premium. That is not the case, of course, with VIXY. The great thing about VIXY is there is no premium and there is no expiry date. So if price holds around current levels for some months, it costs you nothing, except of course loss interest, and I put ha in there because we're all earning very low interest. If you're in the US or Japan, you're basically earning 0.5%, and in Australia and New Zealand probably 2 or 3%, so it hardly costs you anything. The only other real cost is the opportunity of cost of your capital being tied up, but if you trade it on leverage, then you don't have much capital tied up. So be aware, this is a long-term trade. You should expect, or somebody trading this the VIXY should expect to be in the trade for the next 6 months. Why 6 months? Well, there's two reasons which I'm going to go into: the 6-month switching strategy and the weakest months of the year. Let's look at those. The best 6-month period by far for investing in US stocks is 1st of November to 30th of April, and the worst 6 months is 1 May to 31 October. In fact, since 1950, if you had invested 10,000 in the Dow Jones for only the worst 6 months, i.e. 1 May to 31 October you're invested in stocks, and you weren't invested at any other time, your 10,000 would now have shrunk to $8,895, even though you'd done it for 64 years in a row. However, if you'd done the opposite and you'd only invested in the best 6 months, your $10,000, believe it or not, would now be worth $765,000, $765,055. An incredible difference just for investing in one 6-month period rather than the other. Amazing. Also, the weakest 4 months of the year since 1950, which have all averaged a net loss, are May, June, August and September. And of course all of those fall in the next 6 months, including the month we're in, May. Okay, what could cause VIXY to go up? Well, take your pick. Ukraine getting worse, Israel, Iraq, Iran, North Korea, Syria, Russia, Egypt, Greece, Portugal, Ireland and Spain that had all of those indebtedness issues could resurface. We could have an energy shock. US stocks could make an overdue correction. US could start talking about raising interest rates earlier than the market expects, which will cause a correction. China could continue to slow down in terms of its growth. And of course, there could be something else none of us know about yet that surfaces. So let's just talk quickly about the stocks making an overdue correction. As you know, stocks are in year 5 of a bull market, which is the very top end of the length of bull markets, being 5 years. US unemployment's very high, European unemployment is shocking, US house prices are still relatively low, the PE of stocks are near record highs, in fact near levels last seen in 2007. Look, you can do your own research on this. You have your own reasons why you may have your own reasons why there's a correction that's overdue. There's plenty of stuff out there from market gurus and real people who have made money in the markets for decades saying that things are out of kilter. You pick your own reason. How am I going to trade this? Well, I'm going to cautiously add to my position if it moves up significantly, and I'm going to cut the trade on 31 October if it is at or below current levels. Now, just some fun with overlays to see what could happen and what's possible. I'm not calling a crash, but here is a current Dow overlaid over 1928 to 1930. Could possibly happen. Here's 1982 to 87 versus 2009 to 2014. Again, similar up possibly could happen. Now I know that you know, these are only scenarios and these are easy to create, but I do note that one of my trading heroes, Paul Tudor Jones, used an overlay of 1987 versus 28 to 30 to call the 1987 stock market crash and to make a significant amount of money, so they have some validity. Okay, happy trading. Look out for the next chart of the month in June at chartofthemonth.com. Also, please look out for a new more regular service, which I'll be announcing in the next couple of weeks. So that's all from me, Oli Hille. As always, if you are interested in finding out or getting my free trading tips, or you want to pick up my free trading book, you can go to tradingbook.net and register online and you'll get those. So happy trading, have a great month in May, and talk to you soon.